The stock market is a highly speculative arena for investments which involves significant risks. Higher potential returns often include a higher degree of risk. The strategies taught at our events are based on Wade Cook's best-selling books and emphasize an understanding of the stock market and the development of stock and option trading skills. These strategies rely on quicker turnover and higher volatility and risk than may be involved in a more conservative buy and hold strategy. Many people lose money in the stock and options markets. Neither Wade Cook Financial Corporation, stockbrokers, nor anyone else can guarantee that any individual will earn a profit regardless of the method of investment used. Profitability depends on an individual ability to implement a strategy effectively and on an overall commitment to investing. As a result, Wade Cook Financial Corporation cannot and does not represent or guarantee that you will make a particular return or any return.
Hi, thanks for joining me. My name's Wade Cook. We're going to share some time with you here on this video and teach you the formulas that work in the stock market. And I want to thank all of you here for joining me. It's good to have you here. What you see is surrounding me today is a bunch of students that have come to my seminars before, and we're going to show you here today and show you at home how to make money in the stock market, how to turn the stock market into a business. Now, let me go there for just a minute with you and talk about the stock market as a business. I use a comparison because what I want to show people is how to turn the stock market into a cash flow generation machine, because I think that what a lot of people need is more income. You know, as I do radio shows around the country, people are always saying to me, what does that mean? How do you turn the stock market into a business? Well, let me try to kill two birds with one stone. What is a formula on one hand, and what does treat the stock market like a business mean on the other hand? Let's say that you own a convenience store. It's down on the corner, you got a little gas station out front, and you have a convenience store. You just bought it. You're trying to learn how to run the convenience store. You go into the wholesale place and you're trying to buy all the supplies for your convenience store. And you've got pepperoni sticks and potato chips and pickles and all that. And you say, I'm going to buy all these things here, wholesale, and I'm going to take them back to my store, and I'm going to hang on to all these things until I'm 65. See, you would never do that. You would never do that with a convenience store. So what I'm saying is, in the stock market, why not treat it also like a business? Why not put the emphasis on selling, not on buying? You see, in a convenience store, wouldn't you actually buy things for the speed with which they sell? You would want to turn things over very, very quickly. So now you have two fundamental strategies in the stock market. One strategy is to buy and hold. Turn your money over to a mutual fund or buy some stocks and let it go, and you're totally out of control of your money. The other strategy is to turn it into a business. You buy and sell. You buy and sell so that you make actual cash. And I contend, by the way, that the stock market makes a perfect part-time business. Now, what does that mean, a perfect part-time business? If you have your own business, you've got to rent a space, you've got insurance, you've got employees, you've got a lot of expenses of owning and operating a business. Could you not learn how to trade in the stock market, even part-time, like a part-time business, and do this in your back bedroom? Well, let's look at the stock market. You need a telephone, usually, or an internet connection. You have a stockbroker who only gets paid if you do something. You don't need overhead. You don't need employees. You don't need a whole research and development department. You don't need all the traditional expenses of owning and operating the business. You can do it on a cell phone. You can do it in your car. You can do it while you're running your other business. It is a perfect part-time business. I get stories in all the time from people who have been able to quit their job trading in the stock market, again, putting the emphasis on selling. I think that before we get into the strategies and formulas, I like to introduce myself so that you understand to whom you're listening and who's talking right now, and what I have to offer you and what I can offer you and my company can offer you to help you make more money and literally quit your job and retire. And that's big on my agenda. And you might forget that in the future, but even today, as I speak to students that have come to my seminars years ago, I'm still teaching and preaching the same thing. Spend more time with your family, give more money to your church, do a lot of good with your money, but build up the kind of income that will truly allow you to live the lifestyle that you want to live. Well, what do I bring to the table? What do I have to offer? I'm going to take you back. I think to understand where I am today, you need to understand where I came from. Have you ever had one of those experiences in your life that literally changed everything that you do? Everything that you have done after that experience, it's been different because of that one experience. Well, that happened to me. in a day as a cab driver. And I thought it was going to be a part-time job. I drove taxi for 13 months. I thought it was going to be a part-time job. Let me tell you about that first day. The first day, you had to go out training with the cab driver trainer. You had to spend a whole day with him. Well, I went out in the morning. We went on one run. We picked up a lady, took her to a doctor's office, and we were waiting for her to come back out. And while we were waiting, he wanted to go get a cup of coffee. I watched what he did, and I said, okay, I think I can do this. Will you take me back to the lobby, to the cab company? And it was just about a mile away, and he said, no, you have to spend the whole day with me. And I said, okay, please just take me back. I went in and talked to the owner. I said, my name is Wade Cook. I'm a brand new cab driver. You don't know me, but is it okay if I take out a taxi for this? Oh, you have to spend a whole day with a trainer. And I said, I know, I've heard all that. And I was dressed fairly nicely, so I talked her into it. She finally said, okay, just go ahead and take out the taxi for the day. And I went out that day and I made $110. The next day I made $90. The next day I made $140. And I was off and running. I started making between $3,200 and $3,800 a month. Now, to put this in perspective, about 9 months later, the owner, her husband died, and she wanted to have a meeting with all the cab drivers. And we were all waiting for her to come in about 4:30, kind of between a shift change. And we were all talking, and all the cab drivers were talking about how much money they're making. You know, I'm making $600. I'm making $700. And then the trainer spoke up and he said, one month I made $900. $900? And they're all bragging about that. They're all thinking that's really cool. My lowest month was $3,200 a month, and I was a new kid on the block. $3,200, I had $3,800 months. What is going on here, I thought. They just didn't get it. They didn't understand it. You see, I figured out something, driving a taxi, that has changed my life, and now the lives of countless hundreds of thousands of people. I call it the meter drop. Now, it's a simple concept, and let me tell you what it is. When you get into a taxi, the cab driver will drop the handle. Now, today they just push a button, but you remember the handles that used to go down, and then you drop it down to the 3 o'clock position, and it costs $1.50. Now, whether it's a $3 run, a $6 run, or a $10 run, you still get the $1.50. Now, see, a lot of the taxi drivers, they would hang out in the rich area of town waiting for that SeaTac Airport run from Tacoma, Washington, up to SeaTac Airport. That was a $35, $40 run. And then they would get 1 or 2 a week. But they would get 6, 7, 8, 9 runs a day. And I was thinking, my goodness, if I could get 40, 50, 60 runs a day, and that's what I got, then those $1.50, those $1.80s would add up. I get 40 times $1.50, that money, plus the $3, $4, $5, $6, $7, $8 for the run. The meter drop. I figured out that the real wealth is created in more deals. Quit trying to make a killing on one deal. Make a killing on a whole bunch of small deals. I mean, it's simple. McDonald's, you know, the hamburger restaurant, does not make all of its money every year selling one big, gigantic hamburger. They make their money by selling billions of little ones. The key to wealth is duplication and repetition. It is that a hamburger in Tampa Bay tastes like a hamburger in San Francisco Bay. Duplication and repetition. Most people never learn that concept of wealth, so they're always waiting for that big hit. They're always waiting for that big way of making money instead of concentrating on doing layups every day, learning something that works, and repetitiously applying that principle to build up steady income. Now, I took that concept, and I had read a book on real estate. And I was so excited about real estate. But everybody teaching seminars, all the books on real estate were go out and find a house, fix it up a little bit, and rent it out. And then wait for inflation to take that house up. And everybody was buy and hold. Well, I bought into that. And I ended up owning 9 properties my first year. I borrowed $500 from my father to buy my first little house. And I was a landlord to 9 renters. Did my financial statement. You know how you take your assets and your liabilities and there's your net worth? I was worth $120,000. My net worth was $120,000, and then a $65 electric bill came due, and I didn't have the money to pay it. I said, man, something's wrong here. I'm an okay landlord. I'm doing what all these books and all these seminars say to, you know, buying all these rental houses. So I decided to put one of my little houses up for sale. I sold the house, and I carried back the paper. Then I started thinking, whoa, this is pretty cool. I've got all my cash back from this guy that's buying it from me. He's paying me more now to buy the house from me than I was getting as a rental property. Why don't I just go do this again? So I sold a couple more of my rental houses. I went out and found houses I could buy and fix up and sell. And I carried back all this paper. And then at the ripe old age of 29, I was able to retire. I had enough of these checks coming in, about $5,400 a month back then, that I could quit my job, quit everything I was doing, and just live off these checks. My mailbox became my employer. I could just sit at home and take in this money. And I retired. Now, that was the meter drop. You see, instead of trying to make a killing on one deal, oh, I only made $4,000 on this house, and $8,000, and $9,000, and $12,000, and $6,000. I only made a little bit of money on all those deals. but then I was able to live off those $80 checks, $150 checks, $140 checks. It added up to $5,400 a month. That's more than what I needed to pay my bills at that time. So I wrote a book called The Real Estate Money Machine. It's been in the bookstores now about 20 years. I was excited about teaching. I got invited to radio and TV talk shows all around the country. I pretty much gave up all my real estate investing, where I was making really good money, and went into the real estate seminar business. Now that business in the middle of the 1980s took a big hit. Congress changed all the tax laws, real estate values went down, the seminar business just died. And I was having to recover from that. I had employees at that time with a publishing company and a seminar company. I needed money. I needed money to pay the bills. Now, I don't know if any of you have ever been in that situation, have you? Where you just absolutely had to have cash? I mean, I have to cash to pay the bills, to buy groceries? Well, there I was, needing cash. And then I had a good friend of mine who was a stockbroker. He said, Wade, I know you're having a little bit of a struggle right now. Why don't you come and go to lunch with me? And at lunch that day, he shared with me something that literally changed my life once again, because I understood it. As soon as he showed it to me, I said, this is meter dropping the stock market. Now, you got to understand, up to that point in time, I had bought a mutual fund and some stocks here and there. I had a brokerage account, and I bought one mutual fund that had gone up like 12, 14% every year, 3 years in a row, 12, 14%. As soon as I bought the mutual fund, down 2% the next year. I bought one stock at $9. It was supposed to go to 100, and that stock went from $9 down to $7 and hung there at $7 forever. I used to teach my real estate seminars, you know, watch what I'm doing in the stock market and don't do it. Because I did not get it. I did not understand it. It was a new arena for me. The stock market scared me. New set of language. I got real estate down. I mean, I was a real estate kind of guy, buying and selling houses. I figured that one out. But the stock market was foreign to me, and I was afraid of the stock market. But then that day at lunch, this gentleman told me a very fascinating story. I was living in Phoenix, Arizona at the time, and Motorola, even though it's from Schaumburg, Illinois, Motorola is right there in Phoenix, Arizona. And he said, I want you to buy some stock. I said, I don't have very much money. He said, can you scrape together $5,000? And I said, barely, but yeah, I can do that. So he said, I want you to buy Motorola. It's at $50 a share. I want you to buy 100 shares of that, which would be $5,000. I think he charged me like $40 in commissions that first time, being nice to me that first time. And he says, now that you bought it at 50, I want you to sell it when it gets up to $60 a share. And I said, okay, how do you know it's going to go up to $60 a share? He goes, Wade, just do it. I've been doing this now for about 3 years with Motorola. It goes up to around 60, and then I want you to sell it there. I said, okay, sell it. Well, let's just stick with one transaction. I sold it. If you take the $60 times the 100, that is $6,000. Well, you look at this, there's $1,000 profit. Buy it for $5,000, sell it for $6,000. And by the way, this was about 3, 4, 5 weeks right here. And I had $1,000. Even after they took out the commissions, I had $910 left over. And I got to tell you, that $910 that first time, I had to say, Ray, I need a check. Get me a check. I need that money to buy groceries. I've got to have that money. And he said, okay, well, leave enough in there to buy another 100 shares. And I said, okay. So he said, buy another 100 shares of the stock when it gets back down to 50. So when it got back, and I said, how do you know it's going to go back down? He said, Wade, it just goes up and down like this. It just goes on this pattern. And so I bought another 100 shares, and there I was at 5,000 again. And then when it got back up to 60, I sold it. And it got back down to 50 again, I bought it. Back up to 60, I sold it again. I did this with Motorola for about 3.5 years. 3.5 years. I got to tell you, I thought I hit the mother lode. Here's this really cool strategy in the stock market. I don't need to know everything there is to know about the stock market. I don't even need to know everything there is to know about Motorola, right, to really understand everything about this company. Here's a company that is moving in a pattern. Now, I call this rolling stock. If you go to your stockbrokers, they may call it channeling. You see the channels right there? It's a stock that channels between a support level and a resistance level. So let me go back through those words again. You see, when a stock gets down at some levels like this, that is called support. It's kind of like a trampoline. It goes down, 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 and pretty soon it's going to hit the bottom and bounce back up. And then as it gets near its top, it runs into resistance. So it hits this resistance level at the top. So what we're looking for here is a stock that goes in repeated waves. My second stock that I did this rolling stock with was kind of an unusual situation. I was going to a movie. I love going to movies. I was going to a movie, and I was sitting there looking at this theater, and there's lights on the walls, and there's runway lights up and down. I said, wow, this is really cool. Now, this is many years ago. I said, this is a neat theater. I like this. So I called my stockbroker, and he said, sure enough, that stock is a publicly traded stock. That company is. And it was a Canadian company. It was called Cineplex Odeon. It got taken over. It's now called Lowe's Cineplex or something like that. It's not trading anymore. But many years ago, that stock would get down around $2.50. Well, my goodness, let's put some money to this. If you bought 1,000 shares of that stock, that would be $2,500. And if you don't have $2,500, maybe you have 1,000, then buy as many shares as you can with $500. But it's nice to start with a little bit of money, so there's $2,500. Now, this stock would get up around sometimes $3.75, but it'd get up around $3.50. $3.50. Sell it. That's $3,500. Well, there's your $1,000 again, $1,000 profit. After commissions, you have, once again, you have about $900 even after commissions. And then the stock would go back down around 2.5, and go back up around 3.5, back down around 2.5. I must tell you, I bought and sold this stock for 8 years. 8 years it did this pattern. Once in a while, it'd get up around 4, and sometimes it even dropped down to 1.5 just for a short period of time. For a while, by the way, for about 6 months, I was rolling this stock between about 1 5/8, that's $1.62, about $1.50, and up to about 2 1/4. Now, that's not very much money, 75 cents. But what if you could get rid of some of the riskiness of the stock market by finding a stock that fits this pattern? Well, how do you find it? Well, I use a charting service that's called Telechart 2000, TC2000. There's a lot of charting services. We have a lot of these that you can find. We put these on our website, wadecook.com, under WIN, our Wealth Information Network. Let me show you a chart of a rolling stock. Okay, here's a company. This is called, the ticker symbol is DNKY, Don Kenny Incorporated. Now, this stock you can see back here, it was rolling, but look at this roll right here. But once it settled down, right back down here. Now, this is 55 cents. Doesn't sound like very much. 55 cents. It's not very much. But look at these patterns. Well, then back up there. And this is right around $1. So it's not very much money. It is not very much money. It is only 45 cents. And you say, 45 cents? Oh, that's not very much money. Oh, I guarantee you that's not very much money. But when you're talking about $550, and then a month or two later, like 6 weeks or 5 weeks later, your 550 is right around 1,000. And it's only $450 profit. But my goodness, what if you had 3 or 4 of these? Or what if you, instead of buying, see, this is 1,000 shares, what if you bought 2,000 shares or 3,000 shares? Well, 3,000 shares of a 55-cent stock, right? That's only $1,600, $1,650, and then it turns into $3,000 when you go to sell it. So there's $1,400 profit. Rolling stocks is a moneymaker. It has been a moneymaker for me and just countless students. I can't even count all the testimonials that come in.
I'm making twice as much money as I made as an airline captain.
I probably make more money in 2 days than I did in a month in my own business.
Last month we made $27,850 on rolling stocks.
7 weeks I had taken $50,000 roughly and turned it into $200,000.
I've done it. I've made money, and I'm going to keep on making. I'm going to make like $100,000 this year.
The point is, I ask this question all around the country. How many people want to make $100,000 a year? And hands go up all over the audience. I want to make $100,000 a year. And then I continue. If you really want to make $100,000 a year, why are you talking to anybody about making money who's making under $100,000 a year? I mean, I may show you an example here that could make you hundreds of thousands of dollars if you learn it, if you practice it and do simulation trades and get good at it. You can learn these formulas and get really good at them, and they could repetitiously make you meter drop kind of money over and over and over again, and eventually be a lot, the kind of money that you could support your family with. I'm not talking about getting rich. I'm talking about making a little bit extra money, $600, $1,600, maybe $3,000 or $4,000 or $5,000 a month. Oh, yes, it's wonderful to have a $50,000 month and a $100,000 month, but what about some of you watching right now that can just really use an extra $2,000 a month? So how do you find a formula? Well, first of all, you tap into people who are already doing it. So back to my $100,000 question. If you want to make $100,000, why are you talking to anybody about making money who's making under $100,000? Now, find out what the average CPA makes. Find out what the average attorney makes. Find out what the average stockbroker makes, and you'll be pretty dismayed. The average stockbroker does not make very much money. So you could take an idea that can make hundreds of thousands of dollars and go talk to a stockbroker that may be making $60,000 a year. You're showing him a $100,000 a year strategy, and if they're only making $50,000 or $60,000 a year, they're going to badmouth it. You might go home and talk to, I went to this Wade Cook seminar, I'm going to go to this Wade Cook event, and all of a sudden you're being criticized yourself for wanting to get educated, for wanting to get more information. And I'm amazed at how many stockbrokers criticize until they really understand the formula and actually come to our events.
As a former stockbroker and current commodity broker, everything I ever wanted to do to help people make money in the markets was here at the Wall Street Workshop.
This seminar and Wade's books have filled in the gaps in my stockbroker education. Thanks for showing me what I was missing.
I have the background as a stockbroker and have been investing for about 15 years. The strategies taught here really opened my eyes.
Isn't it wonderful seeing what people have to say about us that have actually come to our events? All right, now having said that, let's get back to rolling stock. There are 3 rules with rolling stocks. Rule number 1 is don't get greedy. If you get greedy, if you are always trying to sell at the maximum dollar price and always trying to buy for the maximum or the smallest dollar amount, then you're going to miss many rolls. Let's look at our example right here. In the same example, if we were to buy it at 4 and wait for it to get up to 6, right, we might miss the roll. But look at here. Here's even another roll right here at 5.50. So if we could buy it here at the low level, even at $4.25, and then sell it here right around 5.50, we will make sure that we get in and we get out of these stocks at good points. So that's one rule. Don't get greedy. Don't try to make a killing all on one deal. Rule number 2, and this is a hard one for people to understand, but it is so important. As a matter of fact, this is a rule now that we use with virtually every one of our 13 strategies, which is to know your exit before you ever go in the entrance. You don't buy a stock and then wonder what you're going to do with it. Constantly, as I travel the country and do seminars, people come up to me and they say, well, how do you know when to sell? And then I say, why did you buy? And here's a typical answer. My strategy was buy low, sell high. Nope, not good enough. Did you establish your exit point? So let me give you another example now. And now you'll start to see a lot of this come together. Here is a stock that has that smooth number 1 rolling pattern. You see this stock gets down around $7. So here's, by the way, it dips clear down to $6.50. But if you were to try to buy down here every time, you might miss it. It might dip down there. See, this is almost like one day right here. You might miss that one day. You might miss that one day. So you come right in here around $7, this range right in here, and you buy this one around 7, and then you sell it. Now again, here's 10. This is $11.50. This is $10. So let's go right in this range right here. Let's get out of these at the $10 range. Again, that is not very much money. But to be able to buy it at 7, sell it at 10, buy it at 7, sell it at 10, buy it at 7, sell it at 10, and this one even went up. So after you sold it at 10, you're going to feel kind of bad because that stock went up to $11.50. You can say, whoa, I missed out on that extra $1. But remember, don't get greedy. Be happy with what you've made. And number 3, most of the rolling stocks work on small stocks. They work better on small stocks. Now, if you're going to do the bigger stocks, the big companies, the $90 stocks, the $150 stocks, then we do options on those and what we call rolling options, and that's another one of our 13 strategies. And we'll cover that after a while, but the point here is this. Don't get greedy, know your exit, and do these on the $2 stocks, the $5, the $8 stocks, and it seems to work very, very well. Now, I'm not saying that it's easy, and I am definitely not saying that this strategy or any of the strategies are without risk. They have a certain element of risk, because this company could go out of business, but you establish patterns. You mitigate the risk with knowledge, and the knowledge is not just learning about rolling stock, but is finding companies that fit the pattern. So now let me finish up my comments about formulas. I'm not into hot stocks or the tip of the day. I'm into a formula. And once we learn a formula, then we go look for the stocks or the mutual funds that fit the formula. Now, not all stocks fit the formula. My goodness, the $250 stocks, and boy, they roll. Boy, those $240, $280 stocks, they'll go down to $240 and up to $300 and back down to $250 and up to $290. Sometimes in 2 or 3 days, they can roll that much. They can go $20, $30, $40 in a day. Man, you can make a lot of money there, but that is a whole area of risk that most students don't need to go to. What I'm trying to show people with this one example is that these stocks have a pattern. You can figure out a formula or a method, and you can develop a system. I mean, literally, think about it. When you see a baseball player get in the batting box and he's getting ready to hit the ball, if you watch him time after time, they have figured out their system, right? How to stand, how to hold the bat. And every player does it a little bit differently, and I'm going to suggest that all of my students do things a little bit differently. They find out about a rolling stock a different way, right? They have a way of trading it. Some call on their cell phone, some do it online, right? They have different ways of trading. But nevertheless, underneath all of that is a movement that you can hopefully predict to the best extent possible. It's a movement that goes up and goes down and goes up and goes down, and you just keep making money repetitiously. And by the way, rolling stocks, it is a stock transaction. It is a transaction that we've done in our IRAs. I mean, in our individual retirement accounts, you opened up an IRA at a brokerage firm, and now you can trade. So if you don't need the money, if you don't want to pull out the money, but you want to build up some cash for a nice return, for a nice retirement, why not do it in an account that pays no taxes? Because go back to this whole example. If you take $7,000 and 3 or 4 or 5 weeks later it's $8,000, right? That's $1,000 profit. You got to pay taxes on that amount of money. Now I'm going to ask several questions and then talk about transferring your money-making capabilities from that earned income, where you go to work for someone else or go to work for yourself, and you're trading your time for money. What could you do with just a little bit more money? Now, a lot of people say, well, Wade Cook is this get-rich-quick guy. Well, I don't think so. How about get-rich-slow? Would that be okay? See, now, can I give you an example? People say get-rich-quick, and it just drives me nuts when they say that, because I wonder if you take $10,000 and have it produce $1,000 or $2,000 a month, every month, you wouldn't think that that is rich, would you? Because this is what I teach. This is what I teach consistently, how to take a small amount of money, but have it make actual cash so that you could pay the bills, buy groceries, pay your house payment, pay off your house with this money. Put this money towards your mortgage and get it paid off so you have no mortgage. I guess I'll have to plead guilty to get rich quick if somebody calls that get rich quick, but I don't. How about get rich steady? Get rich steady, where you learn a formula and a system that produces steady cash flow. Will you all agree with that? That you need that steady income, prove it out consistently, and you get that steady income. So let's move on and talk about our next strategy. And by the way, I got to tell you, I've tried to create a seminar that will literally cost you $100,000 to say no a year. Every year, if you say no to this seminar, it's going to cost you more to say no than it will ever cost to come and attend. I spend my time and my staff's time, we have a whole research and trading department, learning the formulas, trying and testing them under different market conditions. We want to be on the leading edge, the cutting edge of everything going on in the stock market, and that is knowledge and education. And the irony is I see it's almost comical. I see these TV ads and TV commercials, and there's breaking glass, and we're going to shatter all the old norms, and we're going to get the small investor, us, enable us, empower us to do all this stuff. They're going to enable the small investor. So, and I have several accounts at these different brokerage firms. I'll go to their websites and I'll say, okay, teach me. Teach me about channeling or rolling stock. Nothing. And I'll go and I'll say, well, surely they have information here on writing covered calls. That's such an easy, cool, I'm going to show it to you in just a minute. Writing a covered call, not a thing. Then I go say, well, stock splits are so incredibly great right now. They've got to have all kinds of information on how to do options and or just how to play the stock in stock split companies. Not a thing. Not a thing. Teach me something. Educate me. So if you really want to get educated, they'll teach you about their next hot stock that they want to sell you or their mutual fund that they want you to buy into. They'll educate you about that so they can sell you something. That's their whole purpose in life, is to sell you something. I'll say it again. I think me personally and our company generally is probably the only grouping of people that you'll ever surround yourself with that will try to sell you a book or another seminar, but we're not going to try to sell you a stock or the new investment du jour. That's not who we are. So let's move on now. And I'm going to teach you now about options. And then we're going to talk about writing covered calls and stock splits. But I need to show you some basic things about option investing. What is an option? An option is the right. There is no obligation. An option equals the right to buy or sell a particular stock in a company. Now, it is called a call option if you are purchasing the right to buy a stock. That is called a call option. If you're purchasing the right to sell, that is called a put option. Now, if you have the right to buy a stock, you are hoping that that stock, therefore the value of your option, will increase in value. If you're buying a put, you're hoping that the stock is going down or decreasing in value. Now, let me get more specific. Let's talk about real estate for a minute. Back to my real estate days, it's kind of a fun example. Let's say that you find a house and you really would like to buy this house. It's worth $200,000 if it was all fixed up, and you can buy this house right now for $150,000. but you don't have the $150,000. I mean, this is a beat up, wrecked house right now. You could get into it with some elbow grease and some paint and fix this thing up. It could be worth $200,000, maybe $220,000. So you go to the owner and you say, I don't have $150,000, but how about if I give you $5,000 right now, and I will buy this house from you in 6 months. So within 6 months, I'll buy this house. I'll pay you off the balance of the $150,000. You have an option to buy the property, an option. Now, you have 6 months. In the stock market, with a lot of the options, we have 1 month, 2 months, up to 6 months. And if you buy leaps, then you have up to a year and a half to 2.5 years to buy a leap, to buy the stock. An option to buy real estate. Now, this example can only go so far, but think it through with me. If this house becomes worth, say, $200,000, with your elbow grease or the value of the neighborhood goes up, and you have the right to buy it at $150,000, how much have you made? My goodness, your $5,000 could become worth $20,000, $30,000, possibly even $40,000 because you have the right to buy the house at $150,000. You've locked in that right for 6 months. Now, what if the house goes down in value? The neighborhood's still deteriorating. In the next couple of months, that house is only worth $130,000. Well, what is your option worth now if the house isn't even worth $150,000? You could lose all or part of your money on that $5,000 because the property's not worth very much. Now, let's use this example, move on now, and talk about the stock market. Let's say that you find a stock that you really like, and the stock has taken a dip now all the way down to $92. It's been as high as $100, $105, and it's dipped down to $92. You really think that this stock is going to go back up. Has every indication that it's coming up on earnings reports and all kinds of other announcements, and you think that it's going to go back up. You call your stockbroker and say, I would like to buy a call option. Now remember, a call gives you the right but not the obligation to buy this stock at a certain price. He'll say, what price do you want to buy it for? Now, strike prices. Strike prices in this range are in $5 increments. You tell him you want the $90 call option. Now, options start at $5, and they on $5 stocks, and they go in $2.50 increments up to $25. So they go $5, $7.50, $10, $12.50, $15, then $17.50, $20, and then $22.50. Once they hit 25, they go in $5 increments, $25, $30, $35, $40, all the way up to $200, and that's when they go in $10 increments, $200, $210, $220, and so on. In this example here, we would like to buy the $90 call option. Now remember, the stock's at $2, so the stock is above this strike price. If we were to buy the $95 call, the stock 92 would be below the $95 strike price. Let's just stick with this example. He asks you what expiration date. Now that's the next thing. Options expire. That is why, by the way, they have an added element of risk. They expire. They're a limited time, a fixed time investment. And if the stock doesn't move the way you want it to move in a certain period of time, you're probably going to lose money on this option. So you should only be doing option money with a very small part of your money. For example, if you have $100,000 to invest, maybe $2,000 or $3,000 or $4,000 would be put into options. If you only have $5,000 or $10,000, maybe $500, maybe $1,000 of your $5,000 or $10,000 should be put into option investing because they are very risky from a certain point of view. I'm going to deal with the risk here in just a minute. But in this example, let's go back to this one. They tell you that it is $6. Options expire the third Friday of the month. So you buy a $6 call. Now, options are in 100-share contracts, so you have to buy one contract, at least one contract. So in this example here, you would take 6 times the 100, and that would be $600. Now, think about this. You now control 100 shares of that stock at $90. You have the right to buy it. Okay, now next point. I, Wade Cook, do not buy options to buy the stock. Did you catch that? I do not buy options to buy the stock. I buy options for the options to increase in value and then turn around and sell the option. If you were to buy 10 contracts, that would cost $6,000, and here's what you've done. You've given your stockbroker $6,000, and you now have purchased the right to buy this company, which you really like, at $90 on or before the third Friday of, say, a month or 2 months away. Let's see what happens now, because this is the powerful sentence that will make you a lot of money and could possibly get you in trouble if you're not careful with this information. When there is a small movement in the stock, there is a corresponding magnified movement in the option. So I'm going to take this, I'm going to put this paper back up in just a minute, but I'm going to take it away for right now to show you what I mean by that. The stock is at $92. The option is the $90 call. We paid $6 for the option. Let's say that the stock goes up in value to say $95, and this option goes to $7.50. The stock goes up to $98. And now, remember the $90 call, now this call option is worth $10. Now think this one through. And if the stock goes up even higher, say to $104, if it spikes up to $104, this option, remember, if it's at 104, it's got to be worth at least $14 because the stock is at 104. Let's say the option is going for $15 at that point in time. You see, the stock has gone up about 10%. About 10%. That's a nice move, by the way. And listen, if you were to own the stock, you'd make some good money. But if you were to own the stock, you would spend, for 1,000 shares, you would spend $92,000, even on margin. If you only have to put up half the money, that would be $46,000. Nice money. The stock moves up from 92 to it's $4,000 profit. Now, do you understand that you would have made more money over here if you would have spent $92,000 of cash, if you have that much money, and you would have sold it for $98,000, you would have made $6,000 profit, which is a lot more than $4,000. But I think all of you sitting here know the point. How much cash do you have tied up? How much cash do you have at risk? The amount of money is more at the $6,000 compared to the $4,000. But the rate of return, the percentage of return, is so much greater for taking $6,000 and having it turn into $10,000. You have a $4,000 profit. See, once you understand the simple law of leverage, oh, then you say, but what if the stock goes down? Okay, let's go there. Let's talk about the risk side of this. The stock's at 92. You think it's a winner. You think it's going to go up, but it doesn't go up. You buy that $90 call option for $6. You spend $6,000, and you own the $90 call, the right to buy the stock at 90. Well, but it doesn't go up. It goes down. The stock tanks down to $88. Now, hopefully, and again, if you come to my seminars, you'll learn to put in buy stops and stop losses. And a stop loss on this, you'd be out, say, at a 50% loss before it drops all the way down to 0. So you would lose money. If the stock goes down, the option's going to go down. But here's the point. What if the stock goes down to 88, then down to 82, then down to 72, even to 62? My goodness. On some of these high-tech stocks and these stocks today, they could go from your $92,000 could go down to $62,000 in a matter of minutes or days. And a stockbroker will say, bad luck, I guess. A stockbroker will say, well, it's too bad. Let's see if we can make it up for you in another way. They'll put you into risky stocks. Now, let me say it again. I think options are risky, but in some ways, they're not even as risky as stocks. An option, a low cost, do you see the low cost here? Instead of spending $92,000 on the stock, you spend $6,000 for the right to buy the stock. And just like in real estate, if you buy a $200,000 house and put $20,000 down, and the $200,000 house just even grows to become worth $240,000, what's your rate of return? You put a $200,000 house to $20,000 down, now the house is worth 20% more, but your $20,000, right, is going to get you back $40,000 in profit. It is the same law of leverage in real estate. It's the same law of leverage in business. And stock option trading allows you to use that same law of leverage in the stock market. Let's go to the other side. Instead of going down, that stock takes off and flies up to that $102 range. That is $13,000. $13,000 that your option could grow to. $6,000 becomes $13,000. Tell me where you have a trade where you get unlimited upside potential and yet limited downside risk, where your downside risk is cut off, where you could only lose the $6,000, not the whole $92,000. So once people understand the power of options and the freedom that they give people to get in, to get out, to use a small amount of money to tie up a large block of stocks, and then when there's a small movement in those stocks, they get a magnified movement in the option. Where do you get that except in stock option investing? And I think people are doing themselves a big disservice by not learning and getting good at stock option investing. Now, here's one thing that people can do. So I'm going to move on now and teach another strategy. And this one should be of interest to almost everyone at home. Let's say that you have a stock that you bought at $44. And let's say you spend a lot of money. Got a lot of money, even in your SEP IRA or in your IRA or in your pension plan. You bought 1,000 shares. My goodness, that's $44,000 that you have purchased, 1,000 shares of this $44 stock. And you like it. And you see that it goes up around $48. It backs off to 47, goes down to 46, back up to 47, 48. And you think that this stock is going to go higher. You really don't want to sell it. Now, if the stock got up to 50, you'd go ahead and sell it. That'd be a nice move. You'd have a $6,000 profit at $50. Well, instead of selling the stock at $50, did you know that you could write a covered call on that stock? So let's explain those words. The word write. Anytime in the stock market that we use the word write, as in writing or write, W-R-I-T-E, that means to sell. Writing a call means to sell a call. The word covered here in this example means that you actually own the stock. Your hedge is covered, your bet is covered, you own the stock, and a call, once again, is a call option. You're going to write a covered call. Why? We're going to generate income. Remember, we're into retirement. We need cash flow to retire. We need monthly income to retire. You call your stockbroker and you say, how much is the $50 call going for 1 month away? Now, I always write these out 1 month, sometimes 2 weeks or 3 weeks, but I rarely go out 2 or 3 months. Sometimes I do, but I rarely go out that far. I write them out about 1 week, I write them out about 1 month. He tells you that the $50 call, when the stock's at 48, that the $50 call is going for $4. We have 1,000 shares of the stock, so we could sell 1,000 times the 4, or we could sell 10 contracts at 4, which would be $4,000. Now, what have we done? And when do options clear? When do we get that money? We sold it. When do we get the money? You know, when you buy something, you spend money. When you buy a call option, we're not talking about buying a call. We're now talking about selling a call. We sell a call, we take in $4,000, and that $4,000 cash hits our account tomorrow. 1 day trading. Now, if it's on a Friday, it's going to hit our account on the Monday. 1 trading day, that cash hits our account. Now, what have we done? What we have done is we have given away the upside potential of this stock for the next 3 or 4 weeks. What we have done, we have agreed to sell the stock at $50 a share. Now, if you don't want to sell this stock at $50, you should not have written this covered call. If you think that this stock is going to go to $60 or $70 or $80, don't sell the $50 call. Don't limit your upside, because what you've agreed to do now, and by the way, this time we've sold, so we have a mandatory obligation to perform. We've agreed to let somebody else out there, we don't know who they are, somebody else out there buy this 1,000 shares of stock from us at $50. Now think this one through. If we do get it taken away from us, you'll find out that on the Monday after the 3rd Friday of the month, and that cash will hit your account in 3 days, that $50,000. If we do get it taken away, if we do get called out, now I know that's stock market jargon, but if we get called out of a stock, it means that we sold it at $50. Well, what if that stock goes to 49? What if it backs off to 47? What about that $4,000? Do we get to keep that $4,000? And the answer is yes. We've taken on an obligation, and somebody's paying us cash for our obligation to deliver this stock to them at $50 a share. And remember, we are perfectly happy to do so. Right? In this example, we are perfectly happy to sell it at $50 a share. Well, now what do we have? We have a stock that's gone from $44,000 to $50,000. That's $6,000 capital gain, plus we've taken in an extra $4,000. Nice trade. But what if we don't get called out? What if the stock's at $49.50? We're right, that stock's moving up, and it's at $49.50 on that 3rd Friday. We're not going to get called out. We're not going to have that stock taken away from us. What about that $4,000? Do we have to give it back? Nope. The answer is no. We get to keep that $4,000 no matter what. So that $4,000 cash is in our account. The 3rd Friday comes, we do not get the stock taken away from us. Now guess what? On Monday, Tuesday, and Wednesday of next week, we're right back on the phone with our stockbroker saying, you know, this stock's at $49.75. What is the $50 call going for out next month? He goes, well, the stock's now at $49.75. The $50 call for next month is going for $6. And you say, whoa, $6? That would be another $6,000 cash that would hit your account the very next day. But you know, this stock's having a nice climb. You say to your stockbroker, I don't know if I want to sell the stock at $50. How much is the $55 call going for? And he tells you that that's going for $3. Well, now think this one through. $6,000 or $3,000? Well, if you take in the $3,000, now you've agreed to sell the stock at $55, right? Remember, you bought it at 44, now you're selling it at 55. See, you've moved up a strike price, you've taken in less cash. So the question is, which one do I do? Which one do you do? The question is, do you want to get called out? Do you want that extra $6,000 now? Do you want to make an extra $5,000 and take $3,000 now, but give yourself the potential of making an extra $5,000? Good questions, are they not? And by the way, do you understand that you can wrestle through these questions all on your own? My books are covered with this, the home study courses, and our Wall Street workshop. And we have hours that we spend on writing covered calls because it's such an important cash generator. And that's what this was for. This was for generating cash income. It is not uncommon, if you had $44,000, to make about 10% a month on your stock, on these options. And if you have only half this money put up, right, on margin, say $22,000, it's not uncommon to make 20, 28%, 22% monthly returns. Now, there are a certain set of rules that we'll go over at the Wall Street Workshop on writing covered calls. Simple rules, again, knowing your exit, but simple rules like you want stocks that are highly volatile, you want to buy the stock on dips and wait a little bit and sell the call on strength. There are a lot of rules that are part of the formulas that we've worked over the years to fine-tune. Just like a high-speed engine at the Indianapolis 500. We do these trades. We do hundreds and hundreds, now thousands of these trades, and have all that experience behind us. Who are you going to hang around with to do these trades? I contend that I want to say we're the best. I want to say we're number one. But then I look around, and there's nobody in second place. There's nobody else out here teaching and showing people what we do. Writing a covered call, by the way, is so cool and so safe, if you will, that they'll allow you to do it in an IRA. You can own stock in an IRA and sell calls against your stock position to generate cash, that $4,000 in this example, in an IRA. It is a worthwhile strategy to study. You won't use it every month, but you'll use it a lot. As you own stocks, you'll write covered calls against the stock that you own. Now I'm going to move on and continue to do another angle of option investing. Now, I think most of you here, maybe by a nod of head, you can kind of help me out here. Most of you done option investing, done option trading? Have some of your big profits come from option trading?
I originally started with $3,000, and then my first month of trading ran it all the way up to $9,000. So my first month I did about 300%, I guess.
Big profits come from small amounts of money if you learn how to do it right. So what I would like to now show you is another complete different strategy, but then take that strategy and marry it up, inosculate it, blend it together with another strategy, which is the option strategy. Remember, options are low cost, limited risk. So let's put those off on a shelf just for a minute. We'll bring them back out to play once we learn the next strategy. I noticed several years ago that as companies did stock splits, there was a tendency, not for all of them, but for many of them, to go back up to the original price that they were at before they did the stock split. So I would see McDonald's, for example, a few years back. It would climb up from 30, 40, 50. When it finally hit $60, they announced a 2-for-1 stock split. Now, we'll talk about what a stock split is in just a minute. But they announced a 2-for-1 stock split. So the stock went from $60 back down to around 30. Actually, it went down to 29, 58 down to $29. And now you had, if you had 100 shares, now you have 200 shares. And it took a while, but the stock climbed right back up to that $50 range, almost to the $60 range. What is a stock split? How can we benefit from stock splits? And then again, how can we play the options on stock split companies? So let me give you an example. Let's say that you purchased a stock a year or two ago at $30 a share. The company's doing really, really well. It's making money. The stock continues to grow, $40 and $50. Pretty soon it's at $60, and it keeps climbing. $60, and it goes right through that, and the stock heads up to $90. Now, a couple of points. Most of us realize that there's not a straight line to wealth. In the stock market, there's not a straight line. In real life, there's not a straight line. There's no freeways to wealth. The road to wealth and the road for a stock getting from 30 to 90 is a very rocky road. You see the charts and the graphs and the diagrams. You see a lot of movement in those. But the stock is finally at $90 a share. You had purchased a year ago or 2 years ago 100 shares of this. That was $3,000 that you had spent purchasing that stock. Now the stock is at $90 a share. You still own your 100 shares, but now your $3,000 is valued at $9,000. And then the company announces a 3-for-1 stock split. Let's talk about the 3-for-1. If the stock's at $90 a share and it does a 3-for-1 stock split, Where you had 100 shares, you will now have 300 shares. Where the stock was at 90, now the stock is at 30. But if you look at it, it is still the same. You still have a $9,000 valuation on your stock. Now, there's nothing magical about stock splits that is going to drive the stock back up to the $90 range. But most stocks go back up, especially if it's a well-run company, if it's earning a lot of money, if there's reasons for the stock to go back up, not just the fact that it has done a stock split. But there is a tendency for the stocks to go back up. As a matter of fact, I'll make you a little challenge. Go into the real world and find a stock that has done a 2-for-1 or a 3-for-1 where the stock within 2 or 3 or 4 years is not back up to the original price. Oh, you'll be able to find a couple, 1 or 2. But here's my challenge. For every 1 or 2 that you find where the stock has not gone back up to the original price, I'll show you 50 where the stock has gone back up to the original price within 1 year. Now, I'll give you 3 or 4 years, and I'll get it down to 1 year. There are an amazing amount of companies, I'm telling you, a lot of companies that go right back up to the original price, sometimes within 2 months, within 6 months, within a year. And look what you've done. In this case here, you would have tripled your money. Your $9,000, if this 300 shares goes back up to $90 a share, that $90 times 300 would be $27,000. And you've tripled your money. Now, you originally bought these for $3,000. Now your account value on those stocks is $27,000. It's just such an incredible play to make, to get involved in companies that are doing stock splits. Now, there are a few losing strategies when companies do stock splits. I think you'll catch those along the way. But let me tell you now the 5 times to get involved in companies that are doing stock splits. I'll make a quick list here. And again, we spend a lot of time on this at our 2-day experiential learning formatted Wall Street workshop. But there are 5 plays when in regards to stock splits. Now, I hope what you're hearing is this. There's 5 times to get out. There's 5 times to sell. There's 5 times to make a profit. Because remember, we're never going to go in the entrance until we know the exit. So let's go through these 5 ways. And I'm not going to tell you everything you need to know because we have the short time together here today. The first time to get involved in a stock split is what we call pre-split or pre-announcement. We'll just use the word pre. It happens before the company actually does the announcement for the stock split. How do you know that this is going to happen? Well, first of all, you can follow us in our research on our website, but you know about a company doing a stock split because they have a history of doing stock splits. Specifically, they have a history when the stock gets to a certain price, and they have a history at a certain time. Say every April or every 15 months, this stock does a split. Microsoft will be an example of that. A few years ago, Dell would be an example of that. Many companies do stock splits about the same time. One of the ones that I like the very, very best is when a company is getting ready to do a stock split and they do not have enough shares. They need to have at their annual meeting or at a special shareholders meeting, they need to have a meeting to authorize more stock. Now, don't get me wrong. The board of directors of a company can, and most companies, can announce a stock split. They don't need anybody's permission to do that. They do not need shareholder approval to announce a stock split. But they do need shareholder approval to authorize more shares. Because see, if we're all the shareholders of a particular company, in order for them to dilute our stock, to have more shares out there, we need to vote on it. And that is a good telltale sign that very quickly after that meeting, there will be a stock split announcement. So the history of doing stock splits at a time and at a money level and the shareholder meeting. And there could be other factors too. You know what? There could be the company coming out saying, hey, we're thinking about doing a stock split. See, there's nothing secret. Remember our $90 stock of 100 shares that is now 300 shares of a $30 stock? There's nothing secret about stock splits because the valuation of the company hasn't changed. It's not really even insider, quote unquote, information. We're just going to announce a stock split. I mean, Monsanto did it a few years ago. They said, we're going to have a meeting and we're thinking about doing a 4-for-1 stock split. Well, they actually announced a 5-for-1. It's just not that big of a secret. So when they kind of telegraph their play, then we want to get involved. That's a good time to get involved. And we've made a lot of money off of pre-announcements. That is a good place to learn how to play stock splits. The next angle to stock splits is number 2, is on the announcement. Now, this time also worries me. Unless you get involved right before the announcement or right on the announcement, and I mean like within 10 or 12 seconds, then you're probably going to get burned on the announcement, because let me tell you what happens. A lot of times on the announcement, the stock, let's say that $90 stock, will even spike up. It will even spike up to say $94. but many, many times between the announcement and the stock split, the stock actually splitting, that stock could easily go back down to $84 and then start a roll pattern. That's number 3. We'll be there in just a minute. My point is that it's scary on the announcement. Because a lot of times before it has climbed up to the $90 range, right before the announcement, the stock has had a nice 90-degree angle. They make the announcement when the stock is at an all-time high. That worries me. But let me tell you what really worries me. You understand that there's a lot of people in the stock market that get up every morning and figure out how to get at your money. That's what they do. They need you to buy something that they have for sale so they can either make a commission or sell you something, and they don't really care, a lot of these people. Some do. But most people don't care whether it goes up or down. They just need your money. And I'm telling you, they need your money so they can make their house payment, so they can support their kids through college. And they have to get at your money. So be careful. And I'm going to say to you, who do you have on your side? Who do you have out there? Because everybody else wants to get at your money, and along comes the Stock Market Institute of Learning, and we're trying to help you learn how to keep your money, protect it. Keep your asset base intact and have it produce little chunks of money. But who else do you have batting for you? Who else do you have on your team? Let me show you exactly what I mean. Stock splits have gotten very popular the last few years. Partly a little bit because of me. My book's hitting the New York Times business bestseller list, the USA Today bestseller list, virtually every bestseller list out there with business books and money books. And I have touted stock splits. It's a great way. But let's go back to our whole idea of options. You have a stock that's at the $92. They announced that stock split. The stock goes from $92 up to $94. Now remember, do you remember that little $6 call option that we were buying on this stock, that $6 call option? You would think that with the stock going from 92 to 94, you would think that this option would go from $6 to $7. But these options market makers can literally turn off their computer, open them back up 10 seconds later, the stock has moved up $2, and that option could open up at $11. You tell me how that happens. So here's the point. If you buy this option at $11, in this case, let's say you purchase the options, 10 contracts for $11,000, and by the end of the day, even if the stock got to 95 and it closed at $93, this option easily, when all the fluff is gone out of the option price, this option easily could be back down to $7 and possibly never recover before the expiration date. Never recover, which means that you'll lose money. So I'm asking you to be very, very careful with this strategy on the announcement. It is one of the scariest times to get involved. Now, what you'll learn as you go through some of our more advanced classes is that you should be a seller at that point in time. When the options are really fluffy, when they're overpriced, you should be a seller of these options, not a buyer. And we don't have time on this video to do that. Let's move on to number 3. What I've seen happen many, many times is that between the announcement and the actual split date, there is a roll pattern that is established. So the stock might go up a little bit and peak out, and it'll go back down, and sometimes even back down lower than what it was before it made the announcement, and they'll roll up to the split date. Let me give you an example of one of those. This is Motorola from the early part of 1999 through the first part of the year 2000. I want you to see down here, look at this roll pattern. Now, this is what we call a range rider. It's riding the range. It goes up, it backs off, it goes up, and the highs even get higher, and the lows get higher, and the stock has this nice tendency. Here, for about 4 or 5 months, it just kind of leveled off. Remember, stock's going up, down, or sideways. Here's a sideways moving stock. And then it starts to roll again, and earlier this year, it announced a 2-for-1 stock split right about here. The stock spiked up, backed off, but look at this roll pattern now on Motorola. It's a nice roll, but it's got that upward bent. The point is, you could buy and sell, especially if you're playing short-term options. Now, the stock is coming up on the stock split, and the stock's up in that $160 range, and it's scheduled to do a 3-for-1 stock split. And you're going to see these stocks move quite nicely as they do this. Now, do you want some excitement in your life? Because I'm going to show you a couple of charts of companies that have a history of doing stock splits that are pretty darn exciting. This one is Microsoft. As you look at this chart here, it started really over here with a stock that got up to around $110. And then it split down to 2 shares at 55. Nice little run up, it backs off, and then the stock runs up again. It gets up to about $160 range, and now it splits down to 2-for-1 down to 80. Climb back up to about $160, another 2-for-1 split, another $80. It climbed back up to about $170, split down to 2 shares at about 85, and now the stock is back up in the $100 range. Now, I want to show you on this same piece of paper what this means. Let's say that you do not have a lot of money. As a matter of fact, for all you teenagers watching, let's say that you take all your babysitting money, all your lawn mowing money, everything you do to earn money, and all you can do way back here is to afford 10 shares of the stock. That is $550. Now, those of you that have more money, say $5,500 or $55,000, you just add on a couple more zeros. But I want to talk to the kids for a minute. $550, that's all you have. This stock runs up, your 10 shares run up to $160 and backs off to $80 after the stock split. Now you have 20 shares of a stock at $80. That is $1,600. The stock runs back up to another $160, does another 2-for-1 stock split, and now you have 40 shares of that stock at $80 or $3,200. The stock runs up again to $170 and does a 2-for-1 stock split, and now you have 80 shares of the stock at $85. That is $6,800? Close enough. And now it's back up to $100. So you would have 80 shares of this stock at $100 or $8,000 in a few years, all starting with your $550. Now, if we had played options on Microsoft, maybe when the stock was around that $55, we would have purchased 10 contracts of the $55 calls. And the $55 calls at that point in time were going for, say, $4. And let's spend $4,000. $4,000. Now watch what happens. As this stock runs up to that 160, and it does a 2-for-1 stock split, when the stock splits, the options split. So now instead of having 10 contracts, we have 20 contracts, and you have the right to buy 2,000 shares of Microsoft at $27.50. Well, the stock runs back up to 160, and it does another 2-for-1 stock split. Now you have 40 contracts, the right to buy 40,000 shares of Microsoft at $13.75. That's your strike price. And the stock runs back up to 180, 185, and it does another split. Now you have 80 contracts of the right to buy Microsoft at $6.87.5. Would any of you sitting here right now today, like to have the right to buy Microsoft at $6 when the stock's at 100? Now just think this one through. If Microsoft is trading at $106.78, you have 80 contracts, that's the right to buy 8,000 shares. Well, 8,000 times 100,000, I mean, if there's no time value left in it, if it's just all intrinsic value, all pure value of the stock, that is $800,000 from your $4,000 a few years ago. Now, this doesn't last that long because some of these options are a little bit further out, so you'd have to be out of them and sell them and be buying and selling. But look at the profits that can be made. Oh, by the way, now are you rich? Would this pay off a house? I'm not saying you're going to make this. You know what? So when I hear my students tell me that they've taken this kind of money and made $600,000 and $800,000, you know what? I'm not promising any of you at home that you're going to make this kind of money. And you know what? I didn't promise those students either. I didn't promise them any kind of monies like this at all. But people do it all the time by getting their money in the way of progress. Getting their money, small amounts, leveraged amounts, low cost, limited risk. Oh, by the way, low cost, what would happen if Microsoft would have tanked back then? You lost $4,000. So you got to ask yourself, is this risk-reward ratio worth it? And I'm going to just make another point on this. I'm not promising you anything, that you're going to make this kind of money. I am not. But can I ask you something? You have a chance of doing this. That's all I'm trying to give you is a chance, a fighting chance. Stack the deck in your favor a little bit. Teach you the strategies that the multimillionaires, the people that trade hundreds of millions of dollars, teach you the strategies that they use with no promises at all. But could you make this kind of money taking $4,000 and put that money into a stock or into a mutual fund? I contend the answer is no. With your money in the average mutual fund out there, you are not going to take it in 2 or 3 or 4 years up to $800,000. It is not going to happen. And I'm not saying it's going to happen with options either, but at least with options, you have a fighting chance. You have a fighting chance of getting your money in the way of progress so your money can go to work for you on a leveraged basis with a small amount of risk and a huge potential reward at the end. Let's move on now and show you stock split strategy number 4. As a matter of fact, stock split strategy number 4 has become 4A and 4B. Now, I hope that this teaches you a lot, because this is what we call the rally into the split. What we've noticed is this. If a stock has climbed up to $160 and announced a stock split, it is very common for that stock to spike up and then down, but sometimes run right up to, say, the $200 range. But sometimes before the split, it might even back off to the 160, or at least even to the 180 range, somewhere in that range right there. Now, that's what I want to talk about. Let's go to the Monday, Tuesday, Wednesday, Thursday, and Friday of the split week. Then a small Saturday and Sunday, we take that time off, and then we go to Monday, and then Tuesday and Wednesday. Here's what we have noticed, and there's a lot of ifs here, but if the stock follows this pattern, it is pretty easy to make money in this one small way. And again, you need to practice trade this, learn this one inside out. And a lot of my students do this trade almost exclusively. It's stock split strategy 4A. If the stock has run up but it's backed off, but it's been to a higher level before, the week of the split, this is the actual split date right here, say on Friday, and a lot of these do happen on Friday. On Monday, or the day after the split date, or what is called the pay date, on Monday, it is called the ex-dividend date. That will be the day after the split date, the ex-dividend date, in this case, Monday. The stock has gotten back down to, say, the 160 on Monday, Tuesday. But on Tuesday and Wednesday, the stock starts to move back up to the 165. If the split is going to be Friday, what we've noticed is that there's a rally usually into the split. We usually get out Thursday afternoon, sometimes Friday morning, but it's very easy for that stock to go back up to the 170, even the 175 range. Now, if you want to buy the stock, that could cost a lot of money, especially with an expensive stock like a $160 stock. But let's say this. Let's say that when the stock is at 165, you buy the 160 calls or the 165 calls. The 160 calls are going for $9. The 165 calls are going for $7. Now, as the stock moves up to 170, that $9 option could easily go to $11. The $7 could easily go to $9. So 9,000 becomes 11,000, 7,000 becomes 9,000, and you have, in this case, a $2,000 profit for a 1 or 2 day trade. As you look at this, you see that there's a lot to learn. There's a lot of practice trading that needs to go on. You need to get your stockbroker up to speed on what we call stock split. You need to get your stockbroker up to speed on what we call stock split strategy 4A. We're going to rally into the split. This is designed to be a 1 day, a 2 day trade. Now, the word day trading, as it's used today, has taken on a new meaning, and I think it's a sad situation. The word day trading today, a lot of people relate it to what is called SOS trading, without even knowing what SOS trading is. That is S period, O period, E period, S period. Small order execution system. That is not what we teach. It is a type of trading put on by a brokerage firm. They want you to be their client. They want you to take your money into their firm, put it in there, into their account, then you go use their computers. Now, I don't know about you people sitting here, but I don't want to sit at a computer for 8 hours a day. It is not the lifestyle that I want to live. I'm playing basketball, and I'm out in my car, and I'm driving, I'm running companies. But here's the big problem. In their system, because they don't want you to carry margin overnight, all trades are back to cash by the end of the day. 4 o'clock Eastern, 1 o'clock Pacific time, you're out. So you get involved at $92,000, and if it goes to $94,000, you're out, and you make $2,000 profit, wonderful. But if that stock goes down to $89, which it just may do throughout that day, at 4 o'clock, you're out at $89,000, and you lose $3,000. Now, that SOS trading has taken over the definition of day trading. So why don't we call it day-by-day trading, or home trading, or house trading, or something like that, so that you understand that some of these trades take 2 days and 3 days. Some of them take 2 and 3 and 4 weeks to materialize. You're buying that stock at 90, but it's going to take clear into the next earnings period for it to get to the level that it needs to be at for you to make money on the option. It's not done intraday. Now, do we do intraday trades? Yes, once in a while we do, but they're just not that common. Most of these trades take more than a day to materialize. Let me tell you now about stock split strategy 4B. It is right at the split or right after the split to get out. In this example, we're talking about a 2 or 3 or 4 day trade into the stock split time, and then we're out. We know our exit point before we ever get involved. We're going to spend $9,000 and we're going to get out at $11,000 or $12,000. We even tell our stockbrokers on the same phone call, okay, we got that option for $9, now let's sell it for $11. And he can enter right on his computer that trade, so it's in there. And if that option hits $9 or $11, at $11, you're out. That's the point. You know your exit before you get involved. Now, this is a very important part of this stock split strategy that you need to understand. So I want to slow down and go through this so you can see what I've discovered. A few years ago, as I was starting to take stock splits very seriously, how options were affected, what happened as a stock went from the announcement time to the split time, and what happened right after that, I noticed an amazing trend of stocks right after the stock split. Now, I could pull up literally hundreds of charts, and there will be a few that will be different than what I'm going to show you here. But what I'm going to show you here is designed to scare you a little bit so that you're not just thinking, oh, Wade Cook likes stock splits, therefore anytime I want to buy a stock split company at any point in time, I'm going to make money, because it's just not true. You need to pick your entrance point and pick your exit point and get better at that part of this trade. Here's what I noticed. I noticed that after a company does a stock split, this one is Intel, the stock was up around 140, did a 2-for-1 split down to around 70. Within a matter of hours, sometimes 2 or 3 or 4 days, this stock takes a dip. Even though this one took a dip right away, it rallied back up. Look at this. Intel split down to 2 shares at 70, and within about a month and a half, you could have bought this stock at $56. And it happens all the time. The point is, get your money out of harm's way. If you see a stock going up to 180 and it's going to split down to 2 shares at 90, and within a few days it's going to go down to 85 or 80, that's disastrous. Now, if you own the stock, you can just kind of wait it out. Or could you even do a better job? If it's at 180 going into the split, why not sell it at 180? Let's say you bought it at 140, you sell it at 180. It splits down to 200 shares now at $90, but in a few days or a few weeks it's going to be at $80. Why not buy it at $80? Sell it at the 180, which is the equivalent of 2 times 90, and then buy it again at $80 after the split. That's the point. There's always a better time. Now, even if it continues to go up, remember, you bought it at 140. If you sell it at 180, you're profitable. Be happy with those profits. And if you still like the company, if you still like the storyline, even if it doesn't go back down below 90, which most of them do, but even if it doesn't, you still have made your profit, and you can get involved in other, peaks and slams along the way. But they're so prevalent that these stocks take a big dip right after the split. Even Texas Instruments, here's a shorter term graph, but Texas Instruments up around 150 last summer, did a stock split down to around actually about 160, did a stock split down to around $81, $82, and then it backed off right down to the $76 range before it started its climb back up. And it's had a nice run, but the point is there's a $5 difference right there. And I could show you chart after chart after chart of these companies that back off after the stock split. The fifth strategy is post-split. You could also look at 4B as a post-split strategy, because after the stock has climbed up to say 180 and it is split down to 2 shares at 90, and then those shares even fall down a little bit, down to say $80, and you like it at that point in time. If you like it for the long term, buy the stock. If you like it for the long term and want to do options, you could play longer term options or even leaps at that point in time, and then watch that nice steady climb back up as you go. But now here's the point though. If you're really after short-term money, there may be a better strategy. You may, instead of using your money here, may want to go back for a short-term strategy to generate more income. So you have to decide if you want to do a post-split strategy on a stock split. Post-split, they're good, but they tie up money for a longer period of time.
My return on my best trade was $2,500 in 4 days.
$750 in 15 minutes.
Probably made about $6,000 or $7,000 in about 24 hours, I think.
We had it for just under a month. We had about $5,100 invested, and we were able to pull out just under $12,000 profit.
I started out doing covered calls. I started out with about $2,000 in my account. I'm up to around $12,000 in my account now.
We almost made in 1 month what we used to make in a whole year.
What does all this mean to you? How can you benefit from this information? You know, you've heard the expression that knowledge is power. Well, it truly is, but really knowledge is potential. You can make it powerful by how you apply it. See, what I've seen is that there's a gap in our learning process. Let me design this out for you. I see that a lot of people need knowledge. They need the pure, unadulterated knowledge, how the market works, how a particular strategy works, how it can make them money. But once they get the knowledge, which is easy to gain, you can read books, you can listen to CDs on the knowledge, then you need to move to the next level, which is understanding what to do with that knowledge. How does it really work? Understanding it and how to apply it. The problem is that there's a big gap. There's a big gap. There's a lack of a bridge between these two in many people's lives. And then the next one, the application. The results that you want. How do you apply this knowledge? How do you apply it? And once again, I see a big gap. What we've tried to do at the Stock Market Institute of Learning is to build the bridges between these three, between knowledge and understanding and application. And by the way, this is a never-ending cycle, and it's a wonderful cycle. You see, once you've applied the knowledge, once you've made a trade and learned from that trade, then you learn more. It goes right back over here, and you have more knowledge, you can make better trades, you get a better understanding, and as you go, as you grow, as you apply this knowledge, you get a better understanding, you get more knowledge and more understanding and more applications and better trades. But where does it all start? Well, it starts by loading into your brain this information, seeing it done. Remember our tell, our show, and our do format in the experiential learning Wall Street Workshop. You know, people don't understand that, what an actual workshop is about, so let me again once tell you what it is. It is a live class. It is a workshop. Please don't wear your suits. Roll up your sleeves and get to work in this workshop so that you can see the trades, learn about them, see them, and then do the trades yourself. Now, we teach paper trading, simulation trading. We want to be the one company that will help you learn how to trade and how to get better results. As a matter of fact, I think we've been very successful at that. We now have literally tens of thousands of people that have come through our two-day Wall Street workshop. And you'll be sitting next to, when you attend the class, you'll be sitting next to a lot of people who are there as referrals from people who have been there before. People who have seen what they've been doing for 5 or 6 months, see the results of what they're doing, and say, I want to get knowledge too. I want to get this information too. And I contend that we're the only place to go to get trained in how to do these kinds of trades. Can I spend a minute and tell you what the Wall Street Workshop is not? If you want a motivational class, a class where there's a bunch of rah-rah and people jumping around on the stage and trying to get you all motivated or trying to teach you how to be one with the universe or something like that, that's the wrong class. This is not a motivational class. This is a in the trenches, how to do the deals workshop. If you want a class taught by someone who wants to take your money and manage your money for you, wrong place. It's not going to happen there. If you need a class that's going to be all hype and all kinds of stuff that doesn't show you any real deals, wrong class. We are talking about real deals. We're dealing with the stock market that day, those 2 days, what's going on with particular stocks and options, real quotes, real prices. Again, they're just a snapshot in time. But if you're going to learn the best, why not learn with real trades? Now, you may be doing paper trades, but some of the trades done in class by the instructors and the trading department will be real live trades so you can see them being done. Now, what's important to me is that you learn about yourself and what kind of trades you can make and you need to be making. Now, see, if you are really a lazy person, you better pick one of these 13 strategies that is a lazy person strategy. So when all the excitement is over with, you're left with a simple little lazy strategy that works month in and month out for you. If you're really a gung-ho person, then you pick a gung-ho strategy and you get into it and you learn it and you do it and you'll probably make a lot more money than the lazy person, but isn't that the way of life? But learn a gung-ho strategy. If you're really high-tech and you like all this internet stuff and computers, then we've got this class and other classes where you can learn all that high-tech stuff and go there and be there. But you need to pick one of these strategies that fits you. Your risk-reward level, your fear level, your knowledge level. Pick a strategy that works for you. Have you not all done that, by the way? If we went around this room, I'll bet every one of you has your own favorite strategy. One of you likes this one and another one likes this one because it fits your personality. And that's what the Wall Street Workshop does. It exposes you to all these strategies. Do you remember I went through that tell, show, and do format? Let me tell you something that's important to me also. If I were brand new at the stock market, if I didn't really understand it, I didn't know the jargon and the language and all that, what would I want? Now, what I would want, seriously, at the very beginning is somebody show me, tell me what's available. Matter of fact, let me show you what I'm after. There are a bunch of traders out there that I call the billion-dollar traders. People that have hundreds of millions of dollars that are making trades. And then there's a whole group of people, I'll call these the stockbrokers, the financial magazine journalists, that whole group of people there that think that they understand what's going on. I had a choice. Along comes Wade Cook, and Wade Cook says, do I want to know what these people that are making $40,000, $60,000, $80,000 a year know? Or do I want to know what these people know? And that's what I started studying. I started hanging around these people, reading their books, very technical, by the way. And if I have any talent at all, it's the ability to take these billion-dollar strategies and make them understandable as I teach them to other people. You have your whole life ahead of you to buy boring asset allocation type investments. There's a whole world of those kinds of investments out there waiting for you. But what are you doing right now to quit your job? What are you doing right now to better your life? What are you doing right now to get more money for your retirement? Even just an extra $1,200 a month or $2,200 a month. What I'm suggesting for those of you that are at home is that you literally take the bull by the horn. Can I say that again? Take the bull market by the horn. Take this incredible bull market by the horn, learn these strategies, get them into your brain, learn the ins, the outs, and how to do them. So let me tell you what the other side of that coin is when I was getting ready to do this presentation. What do I want? I told you a while ago, I want to learn what's available. I want to learn the jargon, the language, so I don't feel like an idiot when I call my stockbroker. When I call and say, can you tell me what the $95 calls on Microsoft are going for? That's a typical question, and I'm saying it the right way. I want to not be an idiot. You know, sound like a jerk when I'm on the phone. I'm serious. I think everybody wants that. You want to learn how to be a professional in the business. And I contend that there's a lot of Americans, even ones that have brokerage accounts, that have never heard of writing a covered call, rolling stocks, repetition making money, predictable patterns. They've never heard of this kind of stuff. And so we come into their life and take these billion-dollar ideas, distill them down to $6,000 ideas so they can make money repetitiously. And so I'm saying, take the bull by the horn. Number one, I want to know what's available. Number two, if I were getting involved in the stock market, if I were brand new at it, I would love to have somebody show me. So I looked at this and I said, okay, here's what I want. I want to know what's available. I want to know how to get results. I want somebody to show me. And then I want somebody to be there and kind of help me tinker with it and explain it and fine-tune it. Well, isn't that what we do? Because, see, that's from a student's point of view. What about from the educator's point of view? As an educator, I said, hey, I want to tell people how to do things, show them how to do things, and then watch over them while they do things. And then getting ready for these tape recordings, I said, I want somebody to tell me how to do it, show me how to do it, and watch over while I do it. And then I started thinking, man, this is all coming together. And I hope it comes together for you. I hope more than anything that you take this seriously. Now, in wrapping this up, I want you to know that we have more than just a 2-day course. We have a third day called our Business and Entity Skills Training Event, where you learn about Nevada corporations, pension plans, limited partnerships, the living trust, and charitable remainder trust. A one-day event, not just teaching you how to make money, but teaching you how to keep, preserve, and protect your money. Is there anybody in your life that will work as hard to keep your estate together as you work to build it up? And before you get rich, even before you start getting rich, why not learn how to get legally structured, financially structured, that will stand the test of time to protect you and your family? Our company, Stock Market Institute of Learning, is really about 5 things. Number 1, showing people how to make money in the stock market, in business, or in real estate. Number 2, helping people lower their exposure to risk and liability. Number 3, helping people lower, even reduce their income taxes. Number 4, how to prepare for and have a great retirement. And number 5, bequeathment. I know I've made up that word, but it's bequeathing in a tender, loving, caring way everything you've worked so hard to build up to your family, to your kids, to your church, to whatever, to make sure that they get everything you've worked your whole life to build up. That is what our company is about. So we share this with you at our Business and Entity Skills Training called the BEST Seminar. And right now, as we were doing this video recording, we're including the BEST Seminar for free. And by the way, it's worth $10,000, $100,000 by itself, depending on who you are. We're including that for free with the 2-day Wall Street Workshop. In the 2-day Wall Street Workshop, People say, well, what does it cost? Well, I want you to call the 800 number on the screen and find out what it costs, because, again, as we were doing this video recording, we had some scholarship tuitions available for partial tuitions. We had some travel discounts available, because we realized that we do these on a regional basis, that you might have to travel as you come to the Wall Street Workshop. And there's some of these discounts or tuition credits available. So please call the number and find out what they are. But let's ask the question the other way. What does it cost not to come? Where are you going to come and learn even some of the things I shared with you here on this short video? Where are you going to learn this stuff? Where? I mean, if it cost $100,000 and you learn how to make $1 million, you'd say, that was the cheapest money I ever spent. Well, it doesn't cost $100,000, but if it did, by the way, it'd be well worth it. What does it cost? It costs, what does it cost if you don't come? That's the question you should be asking. If I say no, I'm going to say no to this. You know, I've been to those events before. I contend that you've never been to an event like this before. But if I've been to a seminar before, well, this is not a seminar. This is a roll up your sleeves, get to work, workshop that teaches by telling, showing, and doing. But we don't want to leave you alone even after the Wall Street Workshop. We have our Wealth Information Network under wadecook.com. It is where we put my trades, our trading department's trades. We got Team Wall Street all around the country doing trades. And any of the trades that we do, sometimes the paper trades, but any of the trades that we do, we put on an internet site. Tell me who's doing that. Tell me who does it. We do it under a format. We explain the scenario, you know, what's going on with Dell or Microsoft or whatever, what strategy that we're using, what number 3 is what our intended results are, and number 4, what our results actually were or what we expect them to be. We go through this process as a tutorial service for our students. And one gentleman just came to me at a basketball game the other night and says, thanks, Wade, I made $57,000. I said, whoa, how'd you make $57,000? He said, I took $19,000, I tripled my money, I got out at a triple $57,000. I said, how many days? And he said, it was like 3 days. Well, he got the trade off of when. Now, we don't ask anybody to copy us. It's not set there to be a system where you can mimic and copy everything. It's a tutorial service to tell you what's available, what you can do. Well, you know what? Right now, we're including 3 months of our Wealth Information Network with the Wall Street Workshop. And so that you don't have any free time in your life for a while, so that you immerse yourself in this, we have a home study course called Zero to Zillions. It is 1 video and 16 audio CDs that you'll put this information in your brain, you'll be able to put them in your car, listen to them over and over and over again until you get to start thinking like a cash flow machine. Again, that course is called Zero to Zillions, and right now we're including the whole course, Zero to Zillions, with the Wall Street Workshop. So again, I ask you to call the 800 number on the screen. Find out course availability. They're selling out around the country. Sometimes there's no seats available. And by the way, just waiting a month or two could cost you tens of thousands of dollars, potentially hundreds of thousands of dollars in lost profits, in lost revenues by putting it off too long. So I'm going to encourage you to pick up the phone. Get registered for a class. Find out about space availability and when the events are going on around your neck of the woods, and get into a class. You will get 3 months of win with the course. You'll get the 2 days of the Wall Street Workshop, and then you'll be treated very specially. We have a bunch of specials and discounts for Wall Street Workshop graduates. Let me tell you what I really want, what I want for me and for our company. I want to be the company that will always give more than it takes. We will always under-promise and over-deliver. When you come to the Wall Street Workshops, and again, I'll get it by the nod of heads for the people saying, you've all been to the Wall Street Workshop, right? Did you think there that you got more than what you paid for? Okay? And that's what we try to do constantly, is to give more than what people are bargaining for, to always give more. We also want to be the company that will stick with you until you make it. So again, the time is now. The time is yours. I know, because I have helped train tens of thousands of students, that you can do it. You can do it. You can do it on your cell phone, you can do it in your car, you can do it in your back bedroom, and you can do it right now in this crazy mixed up market. As crazy as it is, you can do it now. And so I encourage you to make things happen in your life. Thanks for watching.